Into Talking Point. I'm your host, Neeraj Shah. The talking point today is the view that Bay Capital, which is an India-focused investment manager, investing across the public and private markets for the last 15 years, and looking to invest in enduring franchisees early on in their business cycle, believes the digitizing economy, so to say, has and the components within that could actually go ahead and do well over the course of the next 3 to 5 years, arguably the next decade. Siddharth Mehta, the founder of Bay Capital, joins us right now to talk about why does he believe that this is a great investment opportunity and how enduring could this opportunity be as well. Siddharth, good morning to you. Thanks so much for joining in, and I hope all is safe in London.
All is well, Neeraj. Thank you for having me on the show and providing me this opportunity to speak on the theme. I think our view remains, we've been long-term investors in India, and we really are believers that India's economic miracle is well underway. And I think the century clearly belongs to the wealth disparity between the West and the East to be bridged. And India is a key driver of that growth to the global growth engine. Our view remains that consumption is the theme that will propel India to be one of the largest economies globally. In my investment career, I've seen India's economy grow from a $400 billion economy to a $2.7 trillion economy and counting. And I think the way ahead continues to be positive, and I think India's economy will surprise us going forward.
Okay. Now, let me try and figure out. So, Siddharth, there are multiple, thought processes behind what drives India ahead in the next decade. Some people believe that there is a manufacturing renaissance in front of us over the course of the next 3 to 5 years. Technology and while services has been the back end, there's a lot of focus now on the whole digital and the digitalization theme of India and what could benefit out of that. And of course, there's a bunch of people who believe that the China Plus One opportunity in, manufacturing, yes, but export-led manufacturing could be the driving force. Do you believe that all of these could do well, and would there be a first amongst equals? How are you currently looking to invest in the Indian landscape?
I think the opportunity is quite vast and quite diverse, Neeraj. Manufacturing clearly is one of the sectors that is very much the focus of the government's agenda. If you look at the figures, some 100 million plus being added to our workforce would need to find gainful employment, over the next decade or so. So manufacturing clearly has a big role to play in India's next phase of growth. However, if you look back and look at India's economy since it opened up in 1991. Really, there have been sectors that have defined different phases of growth in India. So if it was in the early 90s, it was the IT sector that really made India relevant globally and was the first sector which proved that India could compete, on a global basis. Then you had, financial services that led the pack and led the next phase of growth. And then you had really the generic, pharma companies that stood out and created a global footprint. And over the last decade or so, it's really been the consumer businesses that have driven the market in some sense. I think we believe that while manufactured exports will drive India's growth, a big part of the growth will also come from digital first businesses, technology first businesses. If you look at the tech ecosystem in India, thanks to some of the big structural changes that have been happening in the Indian economy over the last 5-6 years, and the entire digital stack having been created, and the entire theme of democratization of data, which has happened over the last 3 to 4 years, and affordability, accessibility, and availability of goods and services online, really will make sure that digital economy size will grow substantially. So if you were to look at, today the digital economy is some $80 billion in size. If you were to look at China's digital economy 15 years ago, it was a similar size. Today that number is substantially larger. Our belief is that the digital economy in India will be greater than $1 trillion over the next decade, and that there are several champions that have emerged in the digital economy that have made it possible for consumers to be able to, access everyday goods and services and products at an affordable and in a convenient manner, which was not the case, 5 to 6 years ago. And these are the businesses that will gain market share from not only from the unorganized sector, but also from the organized players.
Yeah, well, the statistics are staggering, and I buy that completely. Even in your presentation, you guys have shown about how, be it the number of users, be it the number of people who will start using this because of the age group moving from X to Y, what have you, the stats are loaded in the favor. My question only is that, do you reckon that investing into the digital first businesses, as few as they are right now, but opening up as the year unfolds, would investing in these businesses would be similar to buying high growth stories at a premium valuation, which we have been used to, say, for example, in the financial pocket for the last 5-6 years, or could it be different? Because is there value here, or is the value in growth?
I think there's definitely value because of the growth. If you look at some of these financial services back, if you were to look at valuations over a decade ago, 12, 13 years ago, one would have argued that HDFC Bank, always looked expensive, even 15 years ago, trading at 4 times book. And here we are today, it has compounded, wealth at about, in excess of 40% annualized. I think a lot of these digital champions that are emerging today, on the face of it, valuations may look expensive, to people who don't understand what's going on, perhaps beneath, the scene. And we clearly believe that these businesses and these entrepreneurs and these management teams are disrupting in way everyday, goods and services are consumed by Indians, by being relevant, by delighting customers, and by ensuring that they are able to really create convenience, because India, ultimately the consumer always wants convenience and value at a price. And we believe that a lot of these digital businesses are delivering both. And therefore, their gains over the next decade are likely to be significantly larger. And as these market share gains occur, these businesses are also extremely profitable. So, in a year like last year, where you've had several disruptions, and COVID really played havoc, to supply chains, to the labor market, and a lot of the businesses being able to put their products on shelf and being able to continue to deliver the goods and services to the consumer. I think digital first businesses will really emerge, or already have emerged, as champions, because ultimately the consumer is looking at businesses that were able to continue to service them and serve them through the disruptions without any significant hiccups. So businesses that don't have a digital first strategy, will become archaic. And again, when it comes to sort of creating value, if you were to look at, the total share of market cap of tech businesses, I'm not talking about the IT enabled services, but outside of that, today is less than 1% of India's market cap. If you were to look at China, that number is close to 20. If you were to look at the United States, that number is well over 30. And if you looked at these indices 2 or 3 decades ago, you would have found that again, technology was a minuscule part of that index. And there's been a significant shift in these businesses, in the scale and size of these businesses in the developed economies, and I think India is no different.
Okay, feeding into this is the increased number of users as well, Siddharth, as I see from your presentation, and the fact that the digital user life cycle, as you call in your presentation, right? The cycle of conversion is shorter, arguably, as your study suggests, to 4 to 5 years today. My question would be, would these businesses, okay, let me try and rephrase. Would the cycle towards profitability for these companies come in sooner in a country like India than what other people envisage? The reason I ask this because when I speak to a lot of offline businesses, they make this mention about how they may not have a tech stack right now, but they have the underlying business and they are in the process of adding a tech stack. And therefore they argue that you give us the tech valuation because we're actually running a profitable business beneath. and all we have to do is build a high-class tech stack on top of it, and therefore people will come to them. How do you discern between the two? Because I'm sure you are speaking to such businesses as well.
Sure. I mean, look, we own several profitable businesses in our portfolio, right, that are cash generating, and then that already have a well-entrenched business model. If you were to look at what are the key moats, that a lot of these businesses have, they have distribution, they have strong balance sheets, they're well capitalized. Capital is a very significant moat for some of these businesses. Management probity is a big moat for some of these companies. And if you look at some of these other sort of newer age businesses, it is now attracting, some of the greatest talent in the country, is being attracted to this sector. Capital is no longer a moat. If you look at the kind of investments that are being made, dollar-wise, these businesses are extremely well funded. Hundreds of $1 million of funding has been raised by these businesses, and there is a lot more capital available for those that are worthy of receiving that capital. And in addition to that, these businesses have already emerged, as $200-300 million in revenue, growing at 40-50% annually. So they've reached a critical stage and critical mass, which will enable them to continue their growth story. So they are no longer irrelevant. So if you were to look at a company like Policybazaar, for argument's sake, is clearly disrupting the unorganized sector, where you have $10-12 billion brokerage pool in the insurance category, and there is no institutional player really that has emerged within that category. Or you were to look at Lenskart, which is really the largest organized retailer in the eyewear category. So a lot of these names, a lot of these businesses are solving for everyday problems, and in a way which delights the customer, and that there is significant customer value. So in the process, they will definitely disintermediate some of the well-entrenched players over a period of time. So of course, a lot of the larger businesses spend a lot of money on technology and on going digital, but the reality is, ultimately, unless they have the culture to drive that investment, I think that some of them will get left behind.
That's a valid point. The skeptic would argue, Siddharth, that these businesses globally as well, and again, you might have looked at them, so I would love to have your view, that globally, when we've seen some of these tech IPOs come in, they largely, at least some of the recent ones, have not quite created the wealth that they might have. Forget the Chinese companies, but the others as well. And therefore, I hear a few people say that, the conversation is largely around Zomato, as you would expect right now, because that's the only listed one. But as the others come in as well, the skeptics say that, let's wait, let these companies correct to levels and valuations which might be a bit more decent, because if you look globally as well, these companies are not making money. How would you respond to that?
So look, I don't want to speak about specific businesses. The reality is,
of course,
or comment on Zomato's valuation or anything for that matter as such. But the reality is, businesses that are able to create, to address white spaces in the market and create convenience, longer term will create value. A lot of criticism, was given to Facebook in its early days and saying, how will it ever monetize? And it's just a social network where people, are posting personal information, etc. And in reality, Facebook has become one of the most profitable businesses in the world today. So again, I think businesses have a very clear revenue model today. I think a lot of these emerging digital giants that are coming to the market today have a very clear focus on what is it that they are trying to solve for. Zomato today effectively, is working a duopoly. And whatever people may argue about its profitability, one would have seen what Meituan has done in China, for that matter. So, and the amount of wealth that has been created, for long-term shareholders of Meituan, in that sense. So, I think there are arguments on both sides, and there are good businesses and bad businesses in every sector, every category. I think that probably holds true for the digital sector as well. And there'll be businesses that will continue to create wealth, and there will be businesses that will be poor performers. So the markets and investors have to really be more mindful of where their capital is being allocated.
So that last couple of questions, one of them is again from your presentation, and you've shown it very well about how there are multiple industries in which the time taken for each individual business to reach a critical size or critical level of profitability. For a tech first business, the number of years have come off quite considerably. You've spoken about Lenskart vis-a-vis maybe the Spikers of the world in the past, or Boat vis-a-vis maybe Intex or what have you. Would you reckon that therefore, in the next 5 years or in the next decade, the winners could well be the digital first new businesses in individual spaces which could do this? Or do you believe legacy businesses adopting a tech first model could also turn out winners? And while there might be how do I say, odd ones out, would the winners largely be from the non-traditional businesses?
So I think it's a question of how nimble businesses are, right? I think category to category. I think if you were to look at adoption rates across different categories, have shrunk substantially. So the inertia that people had historically, the consumer had to change. That inertia, has dissipated greatly, especially in some part due to COVID and some part due to technology accessibility. So unless businesses can continue to remain relevant, can continue to remain customer centric, and continue to provide value, they'll definitely get disintermediated. So our view remains that that there are businesses that continue to delight customers even today. That there are 30, 40, 50-year-old businesses that have adopted a digital first policy. If you look at someone like HDFC for that matter, they continue to invest heavily in technology and in their digital strategy, and or Bajaj Finance for that matter. So I think these businesses will continue to grow and continue to be market leaders. However, there are several categories in which the incumbents really have not continued to focus on delighting those customers, and I think those businesses have a greater chance of being disintermediated.
Okay. Siddharth, my final question: when you go out to look at any of these businesses which are tech first, let's assume all the arguments that you made, and there are multiple statistics that you've provided, some of which we have shown in this interview as well, which show that the hypothesis is correct. My question is, how are you going about, or how will you go about in the foreseeable future? How will you go about choosing some of these businesses? Would it be on select revenue metrics, growth metrics, profitability metrics, number of users? How will you go about choosing them?
It's a combination, of the above, Neeraj. We are clearly looking at owning these businesses for the long term. Our investment horizon is a 7 to 10 year one, at the very least. What we are looking for are high quality management teams that are well incentivized and motivated, that have a very clear strategy that they are pursuing and following, are very judicious in their capital allocation, and addressing what we believe is a very large market opportunity. So, a combination of all of the above, I think is probably the right recipe, at least for us, in terms of finding an ideal candidate for our capital.
Okay, let me rephrase. Sorry, this is the last question now. So what is it that will go against a company making it to your list? Are there certain factors out there which are a clear no? It could well be burning capital, it could be what have you. But I'm just trying to understand what is it that will help you easily cross a company off the checklist, so to say.
I think capital allocation. I think we spend a lot of time on looking how businesses have allocated capital historically and how they intend to do so going forward. Do we believe that every incremental dollar that is being invested is going to be accretive to shareholders long term, and how judicious they have been, in allocating that money, to and the strategy that they pursue. So for us, really the golden bullet is capital allocation that we sort of.
But in the tech space, Siddharth, how will you go about?
It's no different.
Yeah, but what parameter? I mean, tech capital allocation towards what kind of resources would either impress you or dissuade you?
No, it's just how is capital being allocated in the future? Is it being invested in technology that is going to be accretive to the value proposition of the business? Is it being invested in people? Is it being invested in customer acquisition? There are a lot of businesses they're also pursuing a pure discounted strategy to earn top line, and that are loss making. I think that probably long term, may not be sustainable in some instances. So our focus tends to be on capital being invested in building long-term moats that will help sustain that business in good stead. So,
got it. Okay. Siddharth, great having you. Thank you so much for giving us a sliver of how you guys think about when it comes to allocating to digital India. Really appreciate your time.
Thank you, Neeraj. Thanks for having me here.
The pleasure was ours. Viewers, thanks for tuning into this conversation.